Okay, so what I want to do then is I want to spend some time looking at the APV model. And I've put together a very simple PowerPoint that we'll deal with for this. I think that I'll go ahead and post it in Canvas for you, but it's very simplified, and there's nothing here that isn't already in some of the other material that you've got. How many of you have viewed the APV model videos that I posted from last Wednesday's conversation? Okay, so I can see some nodding of heads, raising hands. I can see some of you were with us. If you're not familiar with the material from the prior classes, you're going to have a real difficult time in the next class or two as we continue on through our sequence. You're going to find that working in a virtual environment like this, online coursework, takes a different level of discipline than live courses. So just make sure that you've spent the time. Not only will it benefit you, but it'll help benefit the rest of us, because you can ask better questions. I can get a better sense of whether or not you're comprehending, and you can actually engage in the conversation. But with that, I want to go through and talk again a little bit about the APV model, partially because it's a counterintuitive model versus somewhere where we've already been, but also because when we were working on this on Wednesday, we had some technical glitches that made it kind of rocky to follow this. And I ended up having to record the last part of this without any of you present because of that. So let's just go ahead and take a look here. So the adjusted present value model, I'll see if I can't do this in presentation mode. Let's see. Okay. So the adjusted present value model is actually two models put together. The APV model has two different parts. It has value given a free cash flow model construction, plus it has value given a tax shield. Well, let's go back and look at the model itself, the extended model, and you'll recognize the first set of terms here, the sum of the free cash flows divided by 1 plus some discount rate to the T, plus the continuing value discounted for rate and time. And that would give us, what I'm referring to here is value in the free cash flow model part of this, or VFCF. But there's another cash flow that we're dealing with. Well, let's think about that for a minute. We understand at this point what free cash flow is, but I'm showing us that there's another cash flow, and I'm calling it the tax shield. The tax shield, for lack of a better term at the moment, is simply some tax savings we get because we have debt and because we pay interest expense. You know that when a business pays interest expense, it gets to deduct that interest expense from its taxable income. And because it was able to deduct it, it decreases the tax liability that's going to have. Well, I'm sitting here as a businessman. Peter, you're a businessman as well. Do you care whether I give you an extra dollar of revenue in your business or if I give you $1 of savings? Probably not, right?
No, yeah.
Because to you as a business guy, $1 is $1, right? Yep. Whether it comes by new revenue or comes because we saved you some expense, it is $1 of additional EBIT. So you really don't care where it comes from. Well, in this case, a tax shield saves businesses money. It's the interest expense multiplied by the tax rate. I'll show you that in a moment. We'll even go through an example on it. But when you think about it then, companies that have debt and have interest as a function of that debt, which if you have debt, you virtually always have interest, and that pay taxes, which again, that's virtually all the time, have some kind of a extra savings or a reduction of expense that we can think of and that's not captured in the free cash flow. So we're going to think of a second cash flow variable. We'll look at free cash flow, but we also have this extension that we're going to call the tax shield. So if we're thinking about an asset being worth the time discounted value of its future cash flows, then when we think about the adjusted present value model, it captures both the free cash flow and the tax shield as though it were a cash flow, because to us as business people, it may as well be. So here I've broken these out. We've got some value from a free cash flow form plus some value from a tax shield. And it looks exactly as you would expect it to, with one meaningful difference, and that's in this discount rate. And we'll come back to the discount rate here in a couple of minutes. But the free cash flow part of this, or VFCF, looks exactly as you would expect it to. We've seen this model many times, but we've used a different discount rate. And when we look at the value of the tax shield, it looks like you might expect it to had you thought about how to construct such a thing. We take the sum of the tax shields during an explicit period, discounted for a rate and time, and we add to them a continuing value using the tax shield, which is nothing but the tax shield divided by the discount rate minus the growth rate. And then we discount that again for rate and time. So it's exactly what you would expect it to be. But when we put it into this one equation, it's a little bit intimidating because it's just law. But this equation, if you break it into its two separable parts, is exactly the equational form you would expect to see. We could go ahead and state this more, we could state this even more simply, or maybe not simply, in a form you've already seen it stated in before, and that's the present value of the discounted cash flows using free cash flow plus the present value of the continuing value using free cash flow plus the present value of the tax shields plus the present value of the continuing value using the tax shields. So PV DCF plus PV CV. But that would be for each, that would be for each one of these two segments of the equation. So it's actually not nearly as complex an equation as you might expect it to be, given its length and the way that it might look at first. In fact, very often when people come into my office and look at that poster on the left side of my wall, the wall where I've got the monitor, and they see this one great big honking equation, that's the APV model. And most people look at that and say, no, not me, I'm not doing that, I'm staying away from that class. But at this point, you already recognize it's a form that you know, which actually isn't that bad a form. But we need to think about what are the cash flows and what are the discount rates.
And
now,
I have a question.
Yes.
Why would you add the tax shield? What's the purpose of the tax shield?
Okay, so think about this, Martin. An asset is worth to you as an investor its future cash flows discounted for rate and time, right?
Yeah.
Sure. And we know one of those, the one we tend to use most commonly, is free cash flow. But free cash flow doesn't have any reflection on interest or debt. It is totally neutral with respect to how we've leveraged or not leveraged the company, right? There's no reflection there at all. But if let's say you own Central Camp Railroad, and Peter owns a railroad that's virtually identical. It's got the same revenue. I mean, everything's identical, but your railroad was capitalized completely with cash and with equity, and Peter's railroad, like most, is capitalized partially with equity and in a large part with debt. Well, Peter's going to have a lot of interest expense, right? Peter's going to end up having less net income because he's got a lot of interest expense. But we have to think about that cash flow that he's got as a function of the tax shield, which tax shield is the interest expense he's paying times the tax rate. So it's another cash flow, if you will. It's theoretical, perhaps, but it's not theoretical to you if you own that business. I mean, Peter's grateful for this because he knows that he gets some major tax savings. Now, you don't pay interest expense, so you get that savings. He gets a tax savings, and that isn't reflected in free cash flow. So it's a separate cash flow, and we're going to have to think about it and calculate it separately. Does that help?
Okay. Yeah, okay. Thank you.
It isn't altogether immediately intuitive given the ground that we've covered together thus far.
But so that model is more complete than either KVD or just the free cash flow model, right?
Well, yeah, it depends on what you call complete. So I'm going to tell you that the outcome of the KVD model and the outcome of the free cash flow model and the outcome of the APV or adjusted present value model should be roughly the same outcome, right? Because the asset shouldn't differ in value based upon how we chose to capitalize. So it should come up with the same kind of a rate or the same kind of a value. And so I don't know that it's more complete. It has more variable to it. It has, you can make some adjustments with it that you can't in the other. It recognizes where different cash flows are coming from. It's just a different model. And I will tell you, though, that it's a model that tends to be preferred when you have heavily capital-intensive industries like Central Camp Railroad as part of the transportation industry. Okay. Although that said, valuation consultants rarely use it because it's a more complex model as well, right?
Yeah.
Now we're gonna venture on today to talk about the utility of a multiple as a valuation model, and you'll find that a multiple is used more commonly than anything else, not because of its accuracy, but because of its simplicity, and we'll discuss that.
Okay.
So notice that in the model, I use two discount rates, KU and K tax, that you've not seen used before. Oh, free cash flow, you understand. That hasn't changed. The tax shield, you're coming to understand. G is G. And the long-term G should always be 2, 2.5%, 3%, give or take. This is the long-term G. So none of those have really changed, other than you probably weren't already familiar with the tax shield. But this K tax and KU nonsense, this is different, and we need to talk it through for a little bit. So I want you to think about this. In at least one of the problem sets that you'll see where you motivate this model, I'm letting you use WACC as though it was equal to K tax and KU. I'm not doing that because it's likely to be that way. I'm letting you do that because it's a simplification for you, and because it'll show you that when you use the same discount rate for both sides of this model as you would use for, say, the free cash flow model, you're going to end up with a different value than you would end up with in the other models. And it's not because the model's designed to give you a different value, it's because you're using a different discount rate. I think you can understand why this would be. Let's come up here for a minute. Let's assume that we were motivating the free cash flow model itself, and we were using the free cash flows, and we were using WACC as a discount rate, and whatever the time and growth, etc. Well, we come up with some value, right? And let's say that value was 100. Doesn't matter what the number is, but it's a number, it's 100. Well, if we're now going to add another cash flow to this and take the time and rate discounted value of that cash flow, adding it to that, we're going to end up with a number that is in addition to 100. And let's in this case call that 10. So we're going to end up with a model that would give us 110 in value. If we were using the same cash flows for all of this, and if we're using the same discount rate for all of this. So if this is supposed to give us the same outcome of the free cash flow model, then we must be able to use, or we have to use different discount rates. Because if we use the same discount rate that we used for the free cash flow model, let's say we used WACC, it's going to come up with a different value, isn't it? It's going to come up with our free cash flow model value plus some additional amount. And that's not the intended outcome. The intended outcome is a similar value to that which is given by the free cash flow model. So because of that, that must mean that the discount rates themselves are different. So we're going to look at what those might be. Again, in the problem set, or the first of the problem sets that you'll work with that you use this, you're allowed to simplify those and expect that the K-tax and KU, which are simply costs of capital, and we'll talk about how that is in a moment, you're going to be able to assume that they're the same as WACC. But when we do that, we're then going to come up with a value that's different than the one we came up with the free cash flow model. And I have you do that just so you can see that transition for yourselves in that particular problem set. So I tell you here that the discount rates of KU is the cost of unlevered equity. Unlevered equity. What would unlevered equity be? Well, it would be the cost of equity if there's no leverage at play in the company. But I don't know any companies that have no leverage. Oh, there's probably a couple of them out there. And certainly there are some privately held companies that have no leverage. And by no leverage, I mean no debt, right? So it's not only a theoretical number, but it's hard to calculate. You will find in some of my notes that are in support of today's discussion in Canvas, you'll find some equations for KU. You are not accountable for those equations. They are longer than you'd like them to be. They're not any more challenging, but just because of their length, they seem more challenging. So you're going to see it in my notes, but I will not expect you to articulate or motivate the equation to solve for KU. That's the good news. The bad news is we have to be able to think it through a little bit, okay? So I'm going to tell you that it's the cost of unlevered equity. K-tax is the opportunity cost of paying taxes. So Brandon, I'm going to guess throughout your career, you're likely to pay a lot of money in taxes. Would you agree with that? You can just nod your head. Yeah. In fact, you all are, right? And I'm going to guess that any one of you can think about this and say, well, I would just as soon take that money I pay in taxes and spend it doing something else. And given that you would do that or could do that, it opens up that there must be an opportunity cost to the taxes that we pay, because we could do something else with those taxes, couldn't we? With the money we pay in taxes. If you pay $30,000 in income tax in a year, you could have bought part of a new car, you could have gone on a couple of decent vacations, you could have done a lot. So there's an opportunity cost with this. Well, it's hard to articulate that opportunity cost in some respects. I might sit here and think, I don't mind paying taxes. I know that as I pay taxes, I get protection from the fire department and police department. I know I get maintenance on roads. I know I get government intervention in the time of a financial crisis. I know I get social services. I get a lot. Now, some of those things that I might get are valuable to me immediately. And some of those things that I might get, I might think have no value at all. And the problem is that what I find value in and what Megan finds value in and what Fred finds value in may be three completely different things. Maybe I never use some of the great value that's embodied in our national parks and the great outdoors, because maybe I'm just a couch potato. I'm not, by the way, but that might be the case. And so the money I pay in taxes to support those may be of no value to me. Whereas for Alex, my guess is you spend a little bit of time outdoors and you probably like national parks and such. And maybe you would use those readily. And Brandon looked at this and said, who cares about national parks? I just want to take that new Ferrari down the freeway as fast as I can. I want that freeway to be smooth and straight. And I don't want any potholes, because potholes times 200 miles an hour equals dead, right? So we all have our different utilities. And because of that, it is hard to be able to say, the opportunity cost of tax is this singular number when we bring our personalities and our preferences into it. But we can think about it a little bit more broadly and we can come up with a number. Megan, I'm going to ask you to come off mute for a moment. When the government doesn't have enough tax revenue to pay for the expenses it wants to fund, what does it do to pay for those expenses?
Issues debt or raises taxes?
Well, it's going to do one of the two, right? So again, if we have to think about taxes, we're back in a rabbit hole, but it raises debt. It borrows money, right? So we can think about this. We do the same thing as consumers. When we don't have enough cash flow or savings or money to pay for what we want to pay for, we borrow money for this, right? And in this case, because it's so common for governments, municipalities of any kind, to pay for things that would be part of the tax regime through debt by borrowing, we're going to be able to then pretty credibly say that K-tax is most often going to be equal to RD, or the cost of debt, which you might think of as KD as well. Remember this cost issue and reward issue, so K for cost, R for reward, are two sides of the same coin, right? So we're going to use the terms interchangeably. RD and KD would both be cost of debt. It just depends on what textbook you're using or looking at as to which one is used. So when we think about this, we're going to look at a case here for a moment, and these are some free cash flows and some tax shields for the Mira-Dravana case. In fact, let me go ahead and pull that case up for a moment. I sent this to you, and I think you also saw it last week.
Where can we find this in Canvas?
I don't think you can.
Okay.
Yeah, I have not linked it in Canvas Court for you. And you should know the reason for that is because I've only recently done the numeric development of this case. Mira-Dravana is an Eastern European a consultancy firm, and that I've been doing some work with. That's not its name, of course, but I've put the story and the numbers together from that.
Is it the one you sent in WhatsApp?
Pardon me?
Is it the one you sent in WhatsApp?
It is the one I sent in WhatsApp. Exactly. And this form is very familiar to you. You guys have used this form a number of times. You're building your own spreadsheets with this exact same form. So that's why I bring it up here for you. Well, in this, I can come over here and I can look at, I've got free cash flow. And in this one, I also gave myself the tax shield. And these are calculated exactly as you would expect them to be. Free cash flow is exactly what you know free cash flow to be. No surprise there. Now, you haven't seen the tax shield in these spreadsheets before, but it's easily calculable. We literally take the interest expense multiplied by a tax rate. That's all it is. And that's the tax shield. So you can come up with a tax shield for each one of these years. You'll see I've done this here. And now I can go back to and look at my PowerPoint. But just recognize free cash flow is what it is. The tax shield is what it is. Very easy to model. And I've just thrown it in a column here next to my check digit column for invested capital, which always comes up the same as my other way of calculating it, which is fixed assets plus net working capital. So you don't necessarily see these two columns on a spreadsheet you would have for any assignment, but I've got them in this way. And you'll find that on the spreadsheet I sent you earlier today, by WhatsApp. I don't recall if I have the tax shield on there or not, but it's easily embedded because it's such a simple equation. So let me come back to the PowerPoint real quickly. So I've given us these values, and in this case, 2015 is the base year, so 2016 through 2020 would be the years of the explicit period, and 2021 would be the first year of the continuation. Well, I can easily then put all of these values into my model that I'm using, and it's going to give me some outcomes, and we'll look at those outcomes in a couple of minutes. I want to look at how we calculate the cost of unlevered equity and thinking about this cost of tax being the same as the cost of debt for a moment. And we'll look at the spreadsheet for this as well. So I've done something that you've not done before here to approximate the cost of unlevered equity. We need to talk about unlevered equity for a minute and help you understand why I would have to approximate it. Not only is the equation that we might use to solve for it a little bit more gnarly than I'd like you guys to have to deal with at this point, it's still highly theoretical. It's just an approximation. More so even than RE would be an approximation using the CAPM model for the cost of equity. So what I've done is I'm going to say the cost of unlevered equity might be somewhat similar to the cost of levered equity. So we better think about where that may or may not be the case. So unlevered equity would be the cost of equity for a company where there is no leverage at all, right? There's no debt employed. Debt equals the employment of leverage. Well, we don't know companies hardly at all that have no debt involved, and we certainly don't know any big companies for which we have data that we can research and approximate and estimate for which we have unlevered equity. So it's a guess, all right? And I'm going to tell you that the guess that I prefer to use is a weighted average guess. So I'm going to move over to our spreadsheet for Mira-Dravana for just a moment. And I'm going to come over to the financial statement, and you'll see here that I've created KU and K-tax. I want to show you how I created KU. It is simply a weighted average cost of equity when using only equity values. So what you're going to see me do is I'm going to take the value of the common stock and divide it by the value of the common stock plus the value of the preferred stock. Well, the value of the common and preferred together is all of the equity, right? So if I'm taking the common divided by the value of all the equity, I'm getting a percentage of that common as a percentage of the equity, right? Think about this. I'll show you the equation. So in the first part of the equation, I've got common stock, J70, that's my numerator. And in my denominator, I've got the value of the common and the value of the preferred together. And so taking the common divided by common and preferred, I get the percentage of the equity that the common stock represents. And then I'm simply multiplying it, I'm simply multiplying it by the cost of equity. So this is looking very similar to WACC, isn't it? In fact, this is going to be exactly like WACC if there was no debt, because we're dealing with unlevered equity. So we're trying to strip the effect of debt away from this. Well, in the second part of the equation, I've taken the value of the preferred, right down here in J71, the value of the preferred, again divided by the value of both the common and preferred. So here in this first term, I end up with the weight or the percentage of the equity represented by common stock. And in this second term, I get the weight or the percentage of the equity represented by preferred stock. And all I've done is I've multiplied those by the cost of equity, common, and the cost of preferred. So I've just taken a weighted average. Does that make sense? Kind of nod heads or shake heads? Okay, all right. And I thought it would because we're so familiar with weights at this point. Well, as I continue on then, let me go back to my PowerPoint. I come up with a number of 20.05%, as though that were my cost of unlevered equity. And as I said a few minutes ago, we're going to take K-tax and set it equal to RD. And the argument being that if we didn't have the tax revenue to pay for things in our society, then our government would borrow money. And at what rate does it borrow? It borrows at its RD. So using those is different than using WACC, of course. We'll go back and look at Marijuana now. And you'll see how I've got this set up. Come on. Well, it's not helping me. There we go. Excuse me as I monkey around with my screen. I apologize. You'll see how we've got this set up. I've got our basic free cash flow model construction, exactly as you would expect to find it. That gives us a value of 149 and change. And I've got our KVD that similarly gives us a value of about 149 and some change. Oh, they're a little bit different, but then we already understand why they're a little bit different. The growth rate and the ROIC combination here. I end up, though, getting yet a different value again when I have estimated this using, for my discount rates, KU and K-tax. So these are the discount rates that I calculated from the other spreadsheet, right? I'm just bringing them straight over, exactly as you would expect me to do. And they give me a slightly different value. Well, I'm going to put in here for just a moment the value of WACC for these instead of using these two so you can see what happens. So 0.1695, which is our WACC here, 0.1695. And you'll notice when I do that, it gives me a different value again. Which value now is bigger than the ones for FCF and KVD? Because VFCF in the APV model is the same value as the free cash flow model, just as we discussed a few minutes ago. And so if we're adding another cash flow to this, it must give us a greater value if we're using all the other inputs the same, in this case, the WACC. Well, we know that we shouldn't do that because it shouldn't be a higher value. But when I take this back and put these back at 20% or 20.05% and 6%, it gives me a smaller value. Well, does that mean that I shouldn't be using KU and K tax? Or does it mean that maybe my estimated values for KU and K tax are not quite dead on accurate? Well, I think it means that the values I'm assuming for them are not quite dead on accurate. Because again, these are highly theoretical. So let's look at what value for KU must we have to use in order for these values to line up. Should I increase KU or decrease KU in order to get this APV value to come more closely into line with these? What do you think?
Decrease?
Decrease.
Well, if I decrease it, I'm decreasing what's in the denominator. That's going to make the value of the whole term larger, right? So I think that would be right. So I'm going to take this down to, say, 19%. And I'm not quite there. Not quite there. 18%. And now I've overshot it. And my guess is it's about 18.75. It's almost 18.75. Now, obviously, what I'm doing now is I'm guessing, right? I'm not estimating the value of it. I'm guessing at a value. But I started this by having estimated the value to get me in the right ballpark. And then I recognized that KD, or rather K-tax, being similar to RD because of the borrowing when we don't have enough money to pay for something, that probably has a stronger theoretical foundation than this KU deal, which we never observe. So I'm willing to hang my hat, if you will, on K-tax, but I might have to play around with KU in order to get the value to come up to about the same number. Does that make sense? It should beg the question, well, what's the value of this model at all if we have to play with it to get the value to come into line? On these others, we don't have to play with them. We can calculate it so that it comes into line, right? If we've done this perfectly in calculations, it comes into line. Well, if I was going to hold you accountable to the KU equation, the real one that's bigger and more complex and I think you would enjoy, then we would also be able to calculate that, okay? But in this case, I don't want to do that. Well, frankly, just because I don't want to do that. It is not all that satisfying. But I wanted you to see what differences can come out. We could, similarly, we could adjust the value of K-tax. Let's say that we have agreed the KU should be 20%. Is there any argument that would cause us to relax this RD as being equal to K-tax? Can you think of any reason why saying RD is equal to K-tax might not be credible? Does the government, which is the one that borrows when it doesn't have money in the tax coffers to pay for goods and services that it utilizes or creates, does the government pay the same rate of interest that Mira Dravana Enterprises would pay? No, the government pays RS, right? Well, that might be an argument for why we should use a different rate for K-tax. But let's take a look at what happens to the value here when we use RF. Now, I want you to think about what's going on in the rest of our values. We've got growth at 2.5%, WACC at 16.95, ROIC at 17.6. Approximately what is RF in our economy today? The risk-free rate of borrowing?
2.5, around 2.5.
Yeah, it's very close,
Right.
Martin. In fact, if we were looking at this a week or so ago, I would have said 2.4, 2.45, so real close to 2.5%. In the interim, the Federal Reserve has come out and announced virtually zero Fed funds rate, right? And discount rates. Well, what happens to this whole valuation if I take this down to even the 2.4?
Oh,
My value turns horribly negative. Why? What do you see that's motivating this? What do you see that's motivating?
The R is less than long-term G.
R is less than G. So that
Oh,
means
yeah.
in the denominator of the continuing value, we create a negative. Yeah, that's a problem. I'm not even going to try to justify it. I'm not going to try to work around it. I'm just going to admit that's a problem. And it's an argument for why the government's cost of borrowing might not be the K tax. Again, highly theoretical, because for Jaden, who uses a different set of goods and services than I do from the government and different than Brandon uses, we probably have a whole different conceptualization of this, and which conceptualization is probably influenced by our political ideology. So all of a sudden, K tax becomes at least as problematic as KU, which is one of the reasons why you so seldom see the APV model used. But it is interesting to think about what happens when we have another cash flow. That should mean the value of the business should be calculated with all of its cash flows. But if that's the case, we're going to have to think about the discount rates. Any questions that you would have at the moment?
Yeah.
Please.
So what's the goal of calculating the APV model and then playing with the tax to have the same value than the free cash flow model?
Great question. My goal was to give you another heavily quantitative assignment just to annoy you and make your lives miserable. Okay? And as long as I succeed, I'm a happy guy. Or my goal is to help you think through something. Sometimes we might have to think about businesses as having separable parts or separable cash flows. And using the APV model as an example gives you the opportunity to have to motivate a model where you have multiple cash flows. Okay? Now, this whole discussion of how we try to bring them into line with each other is a little bit different. And it's trying to help you see that when you have put together the spreadsheets, the models, well, you have created something that lets you play, oh, wow, that can't be right, lets you play what-if games. And when I play my what-if game, knowing that these values should end up being relatively closely aligned, it tells me that my cost of unlevered equity probably is less than my cost of levered equity. Does that make sense? Would the return we would get from an asset that uses no leverage, would we expect that to be higher or less than the return we would get from an asset that uses leverage? What do you think?
Higher.
Well, I think that we use leverage in order to amplify returns, right? So if I'm not using any leverage, I would expect my return to be less. So if I just took the 20% that came about by looking at KU in this equation isn't unlevered equity, because this preferred and this equity exists in the same company where we have a substantial amount of debt. These aren't unlevered equity. How do we separate out from the common and preferred stock the effect of leverage in the rest of the company? We can't. Some of the returns, some of the performance that the company has is because it exists in a marketplace or in a company in which leverage exists. Well, it exists in a market in which leverage exists. So that means RM is reflective of a market in which leverage exists. So we've tainted these numbers. The RE that we're using here at 20.93 is tainted by leverage. So this isn't a perfectly cost of unlevered equity, but we would expect that unlevered equity would have a slightly lower return or cost than levered equity, which is one of the reasons why when I started to play with this, I started to decrease the amount rather than increase it. The other reason is I knew that algebraically, if I had increased it, it would have gone the other direction. It would have made the value smaller, not larger. And I was trying to make the value larger to come into alignment with the existing values I had. Okay? You'll better understand this model once you've motivated it a time or two. So you'll do that within the upcoming problem sets, not the ones that to do tomorrow, of course. But I do think you motivate it in the next Excel assignment.